Hello, Jason Bates here, owner of Electrum Financial, a mortgage broker located right here in beautiful Scottsdale, Arizona, where a mortgage is not a flip of the coin. If you're looking to purchase or refinance a home in Arizona, I'd like to be your broker of choice as I have access to the lowest rates at the lowest costs in Arizona. If you don't believe me, call me, as I say in all my videos. All right, so I get asked all the time about what's going to happen with the Fed funds rate? What's going to happen with the mortgage interest rates? What's going to happen with housing? Are we facing another crash, Jason? And I said, no, we're not. And I'm going to go into that here. I put this PowerPoint together that I want to share with you and give you my insight as to where I'm coming from, my perspective on things. So let's dive right into it, shall we? All right. So now we know the Fed is going to play a major role. And we know that they've already decided to go and start tapering. Let me change my slide here. They've already started to taper last year and started to taper into 2022. And that means buying less mortgage-backed securities. And they've said they're going to earmark some rate hikes and even getting very aggressive with that notion. And the St. Louis Fed chair came out recently and said, hey, well, I'd like to see a 1% rate hike at the next meeting. I don't think that's going to happen, and we'll go over that here in just a second. But they're going to let their balance sheets also run off instead of reinvesting the mortgage bonds that pay off. They said that this is something they're going to contemplate, and that could have a big effect, not being so decisive, but just contemplating on it. So it gives some question out there in the investment world as to what the Fed may be doing. So that could have a major impact on things. And the Fed, we know the Fed's actions can definitely impact the stock market, drive interest rates, and affect housing and jobs. So the Fed is going to play a major role this year. Because the Fed is going to play such an important role, let's go over what the Fed is. So the Fed is made up of of voting members, 19 to be exact, and 12 of them actually are the ones who vote on policies. 4 members rotate in and out of the Fed each year. So the composition of the Fed with this rotation should be a little bit less accommodating and maybe lean a little more toward tightening than the batch of Fed members that were voting in 2021. We know that inflation has really gone up quite a bit, the highest inflation number since that we've seen in 40 years, and that's going to be the Fed's main focus this year. Stock market's reaction to what the Fed does could make the Fed lose their resolve if the reaction is negative, and this has happened in the past. So we got to watch that very closely. Now the Fed, let's be honest, the Fed should have hiked rates sooner, and that's for sure. But they mistakenly thought that inflation was transitory. Remember that word when they were all saying that last year? It's just transitory. It's transitory, this inflation thing. Now, let's take back at history. Let's take a look back at history, because history can help us understand what may happen in the future and the actions that will influence the market. If we kind of think of what the Fed is going to do, we can see how actions like this affected the markets in the past, and that can give us some clues as to what we may be expecting going forward. So let's go all the way back to 1970 and the 70s. Here's a picture of the Fed chair at the time, Arthur Burns. He ignored inflation and insisted that inflation was transitory. Does that sound familiar? Man, sounds familiar to me. Remember the many times you've heard that word, and right. But year over year, inflation under Arthur Burns, it really ballooned. It went from 7% in 1978 to 14% by the time he left. Wow, 14%. Can you imagine 14% on inflation? We're at 7%. He was at 14 by the time he left. Now, Burns remained steadfast and insisted that it was transitory. Now, mortgage rates responded because, remember, bonds, including mortgage bonds, hate inflation because it erodes the fixed return you get when you hold a mortgage. The return you get on that mortgage is fixed. So you're buying things with a fixed budget. If the cost of those items that you're buying are rising very rapidly, it's making the value of that fixed return less and less and less over time. So the only way you can help combat that is on future loans that you do. And lend out, you've got to charge a higher rate. And under Arthur Burns, mortgage rates did just this. They went from 12% to 18%. Now, 12% probably looked pretty good as before rates got up to 18%. But can you imagine getting a mortgage rate today at 12%, much less 18%? I mean, that is insane. Now, Paul Volcker came in and he wanted to fight inflation. He hiked the Fed funds rate from 11% to 20% in 2 years. Now, the Fed funds rate today, and at the moment, is at 0%. Likely to go up this year. Of course, it's going to go up this year, but right now at this very moment, it's at 1%. 11% seems like a whole nother level. But then to take it to 20% in 2 years, holy cow. We make a big deal out of a 0.25% rate hike. He hiked the Fed funds rate in 2 years by 9% on the Fed funds rate. And he was very, very effective in fighting inflation by taking these drastic measures. That's for sure. Because inflation, which remember, under Arthur Burns got up to 14%, it moved all the way back down to 5%. Because inflation dropped, mortgage rates also dropped, and they dropped very quickly. And remember, under Arthur Burns, they were at 18%, and they moved all the way back down to 12%. Yes, 12% is not great by today's standard, but man, oh man, I don't care who you are, 12% is much better than 18%. Now, there are consequences to these actions from the Federal Reserve. The S&P 500, well, it declined. It declined by 30%. So 30% loss in stock prices during that time. And this tighter monetary policy pushed the United States into a recession in 1982. So 2 years later, we were facing recession, but he did curb or slight inflation. So there were some positives to what he did, but we did fall into recession. So now let's go on to Alan Greenspan. A lot of you may remember Alan Greenspan. He comes in, and Alan Greenspan was Fed chair for a long time in the 90s, and he saw inflation double. It went from 1.75% to 3.5%, so it rose about 1.75%. And higher inflation caused mortgage rates to rise because, as I mentioned before, investors demand a higher return to combat inflation. It went from 7% to 8.5% on a 30-year fixed mortgage. And unlike Burns, Greenspan took action in mid-1999 because he saw what happened to Burns, and he saw that Burns was wrong, and he wanted to be proactive. He didn't want to get desperate like what he saw happen under Paul Volcker. When Paul came in, he had to be proactive because he had no choice but to be aggressive because Burns screwed it up so bad. So Greenspan wanted to be proactive, and he hiked the Fed funds rate by 1.75%. That matched the rise we saw in inflation. So he took it from 4.75% on the Fed funds rate to 6.5%. And he did that in just 1 year. Now, inflation responded and dropped from 3.5% all the way down toward 1%. So it was very effective. Mortgage rates responded as well as they dropped from 8.5% on a 30-year fixed down to 5.5%. And that sparked a huge refi boom. But even then, there were consequences. The S&P fell by 50% from the spring to the fall in just 6 months. Man, oh man, that was really painful in 2000. And then the US entered into recession in 2001. So twice we've had to fight inflation. Twice the stock market has lost significant value. And twice we've entered into recession. So now let's jump to today. Jerome Powell, he saw inflation increase from 2021 to about 1.75% to 7%. Some may even say that we're a little bit higher than 7%. And now it may even be really out of hand by some estimates. Remember, Powell kept saying that inflation, just like Arthur Burns, is transitory. Right? Remember that? Transitory, that key word there. Greenspan seemed to learn, but Powell has fallen into the same trap as Burns. Now, to be fair, Powell in 2021 was between a rock and a hard place. And if we take a look back at 2021, there was a lot of stimulus money being passed out, and shutdowns were still a thing back then. Not too long ago, right? We still had states shutting down, businesses shut down. So to raise rates, which affects credit card payments, would seem like a double whammy for those who were having a difficult time making rent last year. Now, higher inflation has caused mortgage rates to rise from 2.5% to close to 4%, even over 4% in some scenarios. And seeing that rise, obviously, it's because inflation has been rising. Now, the Fed started just at the end of 2021 tapering the purchases of mortgage bonds and treasuries. And they're not going to do two things at once. They're not going to hike rates and at the same time reduce purchases of mortgage-backed securities or MBSs. So the plan is to reduce tapering in March through March and more than likely start raising rates in May, which coincides coincidentally with the May meeting. Now, it certainly could be sooner, but I would definitely consider this to be the most likely plan. And because of this anticipation, we've seen mortgage rates rise steadily since the beginning of the year. The Fed is likely to hike rates and the Fed funds rate, 3 times this year. Now, could be more, could be less, and it's probably going to be 0.25% each time, or could even take a more aggressive approach, as I said before, from the St. Louis Fed chair. He wanted to raise it a full percentage. I don't think that's going to happen, but it could be more aggressive and do it at 0.5% each time. Hard to really say right now at this very moment, but the one thing I can be very confident is that the Fed funds rate is going to go up, and the rate hikes could carry over into 2023. Now, inflation and interest rates can still rise until the Fed acts, because inflation is probably going to continue rising through February into March, maybe even a little bit longer, as the Fed is still injecting liquidity into the market through purchases of the mortgage-backed securities. So until that stops and the fiscal side of the government stops raising the debt ceiling or producing even stimulus packages, it will continue to erode the dollar, causing inflation to continue rising. Now, there are two things need to happen. The government stops spending money, stimulus, raising the debt ceiling, or the Fed funds rate needs to increase. The likely scenario is the raising of the Fed funds rate. Can't count on Congress not spending money, right? Now, if the Fed is able to get inflation under check, then mortgage rates will respond and they should drop. But they will drop from the higher levels. They're not going to drop from the lower levels. Okay, so let's see if we can see a pattern that's going on here. So if we look at Burns and Volcker, inflation was at 7% and it rose to 14%. Mortgage rates kind of did the same thing. They were at 12%, went up to 18% during that time. And the Fed funds rate was at 11%, went all the way up to 20% to help combat that inflation spike. And inflation responded and went from 14% down to 5%. And mortgage rates went from 18% down to 12%. The consequences were the S&P lost 30% of its value and we entered into recession. And under Alan Greenspan, inflation went from 1.75% to 3.5%. Mortgage rates went from 7% to 8.5%. And the Fed funds rate was 4.75 to 6.5. Inflation responded by also dropping from 3.5 to 1%. Mortgage rates followed that inflation response from 8.5 to 5.5. S&P, remember, it lost 50% of its value and we entered into recession. Now, under Jerome Powell, we've seen inflation spike here. It was at 1.75. And keep in mind, the Federal Reserve likes to keep inflation at about 2%, at a 2% rate annually. So 1.75 to 7%, that's a big jump. That's a really big jump. And mortgage rates have gone up. Now they're a little bit low here as opposed to where they were before, but they went from 2.5 to 4%. And in some case scenarios, even above 4%. The Fed's funds rate is at 0. It's likely to get to 1% if we look at the 0.25% rate hikes, maybe a 0.5% rate hike. in 2022. So we're going to be near 1% by the end of the year. As a response, inflation should get under control, should drop, and we should see mortgage rates respond, and they should decline. They should decline as inflation declines. Now, stock prices, they're expensive, and the economy is slowing, so we may see a recession. Hard to say for sure, but we may see a recession. Now, there are some wild cards to this. COVID plays a major influence here on this whole monetary policy. And remember, there are two policies. There's monetary policy and there's fiscal policy. Monetary policy being the Fed fund, Federal Reserve, and fiscal policy being Congress. So we're going to see continued supply chain issues. Now, if we see a surge in COVID or a new variant, that could affect the monetary policy for sure. Now, on the fiscal side, if we see stimulus, that could fan the flames of inflation for sure. That would push stock prices temporarily higher because an injection of money into the stock market loves liquidity. So if you inject money into the economy through stimulus, the stock market really loves that liquidity, and it will push those stock prices artificially higher. That will cause mortgage rates to also increase a little bit, and that will make the Fed's job and the correlation with inflation more difficult to get under control. Remember, on the finance side, there's the Fed side, there's the monetary policy and the fiscal policy, and they really need to be in lockstep. They need to be on the same page if they're going to get inflation under control. Now, remember, I said before, the run off the Fed balance sheet, the first step is they're going to stop and start tapering the purchases of the mortgage bonds and treasuries. And the next step would be to hike the Fed funds rate after that. And the Fed right now is still buying $70 billion per month in mortgage-backed securities. And that's helping to keep the rates artificially low for the time being. So as the Fed's buying this debt, it's injecting the economy with money. It's just done on the Fed level versus a fiscal level. And that's keeping the rates artificially low for right now. And when the Fed stops buying these investments, rates could move higher than we previously thought. So if they abruptly stop buying these mortgage-backed securities, that's going to send a little bit of a shockwave into the system, or into the system, I guess is the best way to put it. And that could push rates and push them a little bit higher than we anticipate. Now, the stock market is expensive. If the Fed funds rate, Fed hikes, when the Fed hikes the funds rate, it will likely pull the stock market down. And, I'm kind of making a prediction here. I'm thinking the stock market will probably correct, maybe 10%, maybe a little bit more. It could be a little bit more depending on what the Fed does and how aggressive they get. I'm thinking at least a 10% correction in the stock market for 2022. So we're not going to see a big explosion in 2022 until this inflation gets under control and the country really opens up on that. Now, interest rate forecast. I anticipate mortgage rates to rise along with inflation during the first part of the year toward 4%, maybe a little bit above. Some scenarios are going to be a little bit above that. But then as the Fed takes action, we're going to see the market soften a little bit. We're going to see this economy slow because the Fed funds rate drives a lot of that, the pace at which the economy is expanding. And interest rates toward the end of the year should head lower in the second part of the year and get to that 3% level, back to where we were, maybe even a little bit below 3%. We'll wait to see, but certainly down toward that 3% mark. Now, if the Fed reacts, and they react swiftly, we could see rates artificially go a little bit higher, and then as a result, that could pull us out of, maybe recession. We'll see, but it could pull us out of recession even sooner. So it's really going to depend on what the Fed is going to do, how quickly they react. But I'm thinking rates rise toward 4%. We're already kind of pretty much there, really, for that matter, for the first half, and then decline. I think they'll start declining toward the end of this year and be back toward 3%. Now, housing forecast. Housing will remain strong in 2022. 2022, but not as strong as 2021. We can't keep seeing double-digit appreciation. That's just not sustainable. Everybody knows that. But I do think it's going to remain strong in 2022. We're already seeing that now. Inventory is super low. So that clickbait YouTube stuff that's out there, that the economy is going to crash, that is exactly that. It is clickbait. Now is a great time to purchase a home. Now, demand will be slightly softer due to the rise of interest rates, but still robust. Supply will increase, but remain tight, and tighter labor, supply chain disruptions, and semiconductor shortages will all play a role. And a lot of people think, well, semiconductors, what the heck does that got to do with housing? Well, that goes into your washer, dryer, refrigerators, and those are all appliances, a lot of TVs. That all is appliances that you put in a home. And a lot of people purchase new appliances when they purchase a home. So that could affect housing there a little bit too. Now, rents, when we look at rents will continue to rise. And I think rents will remain above 5%. And that will push many people to see the benefit in buying. It used to be, why rent when you can buy? A lot of people over the past few years, hey, it's too expensive. I'm getting cheaper rent. Well, rents are starting to creep up there. So we'll start to see that notion come back. Why rent when you can buy and get the tax advantage? So forecast for housing, mid to high single digit appreciation, still providing a great wealth creation opportunity. Are we going to get double digits this year in appreciation? I don't think so. But could we see high single digits? Yes. Even low double digits is very, very possible this year. So that's my housing and rate forecast. I hope you enjoyed that. And until next time, I hope everybody stays safe. And if you need a home or a mortgage in Arizona, I would like to be your broker of choice. So until next time, take care and stay safe.